Welcome to our brand new, this is the inaugural presentation of our brand new trading course. Here we go. Now, new foundations for option market trading. Yeah, as I was saying, today is quite a day. It's could be rather, well, it is rather historic. We have now, at least the Dow has joined some of the other indices like the Russell, but the Dow, the media will be going apoplectic over this. You have a new all-time closing high in the Dow. Now, as promised, at the end of the material that I had already prepared for tonight, we're going to take a look at some things in this equity indices. I was doing the report this weekend and started looking at things and got deeper and deeper and deeper into it, and I thought, wow, this is really, pretty neat stuff from an auction market perspective, but also from a trading perspective. How do you trade this market at an all-time high? How do you trade this market that is just it's just a straight line up? Is there, do these concepts that we talk about that are so robust, do they work in this environment, or do they not work in this environment? Is this one of those times where nothing works? And we're going to answer that question. We're going to take a look at some things that have been going on since this low in 2009. And that's what we're going to wrap up with. Now, something else, let me get this back over here. This is the first time that this material has been presented. As a result, I am planning on this being 2.5 to 3 hours. That is a guesstimate. A lot of that is going to depend on where we head down in the various topics and questions and things like this. One of the things I'm excited about in this new course is the format. And the format is that we're going to do this once a week for the next 7 weeks. And we're going to do it in more bite-sized. Some of the old courses that I gave, I would do them all day Saturday and/or all day Saturday and Sunday. And that became rather tedious for a lot of people, not only in the live presentation, but also then when you wanted to go back and review something, you could, it was difficult to find it, mark it, etc. if you have a 6-hour recording. Well, these are going to be 2.5, 3 hours, maybe a little bit more in some cases, a little bit less in other cases. And the other thing is that if there is material from one week to the next that needs to be reiterated, if there seems to be a particular need or emphasis or desire on your part to expound more on certain things, then I'll have a chance to add that into the next week. So this really is going to be a very dynamic course as we move forward. Now I'm going to show you, this is the outline. Now this is on the web page, auctionmarkettrader.com, so you can go each week and you can look at the things that we are going to cover. So tonight we're going to cover, we're going to talk about the basics of trading. What are we trying to do? Why is it difficult to trade? Some common practices that all should be avoided. And then some things that I think can immediately improve your trading regardless of where you are. We have quite a diverse group in here tonight. We have some guys that are pros, professional traders, and have been professional traders, some as long as I have. And we have some guys in here that have been clients of Alexander Trading and are thoroughly immersed in trading auction market concepts and the profile graph. And then we have some people in here that are brand new to this. And my message to the people that are brand new is that don't sweat trying to understand everything that you see. Now tonight it's going to be will be pretty straightforward. We're not going to get into a whole lot of minutia tonight. But this is a broad, deep methodology. It is not some gimmick that, all right, if this line does this and that line does that, then you go long here and put your stop there and you risk 3 ticks. This is not what this is about. But at the end of the evening, hopefully, those of you that are new will at least walk away with the idea that you're seeing something that is really, really unique. So, here is the risk disclaimer. Trading is risky, and it is risky. You know, this is a required disclaimer, but it's very, very true. One of the ironies to me about this disclaimer is that as long as I put it up here, I have quite a latitude in the broad category of truthfulness. Anyone that puts this up here is basically covering themselves. Well, I'm not covering myself. I'm telling you up front, trading is really, really risky business. A lot of you have blown up accounts. I've blown up accounts. You've known people that have blown up accounts. It's really easy to do. And if you're just beginning to trade or learning to trade, learn to trade before you begin trading real money, or learn to trade before you begin trading money that you truly can't afford to lose. And if you begin trading before you really know what you're doing, understand and accept that you're going to lose that money, because you will. So my goal in this course is going to be to teach you something that is truly unique in that it's valid. There are very, very, very few valid things out there that are being promoted as how to trade, ways to trade, gimmicks to trade, indicators to trade, software to trade, platforms to trade. Trading is both infinitely more simple than it is presented, but at the same time, it eludes 99.9% of the people that try to do it. We're going to talk a little bit about why that is and what we can do about it. And good news, bad news about this methodology, you're not going to master this in 7 weeks. As I said before, I'm looking at a list of attendees, and some of the people that are attending this webinar tonight have been clients of mine for many years and have taken all of my courses, and in some cases have gone through my mentoring program, and they will tell you this is not something that you're going to master really ever. And that the good news about that is that this you can grow with this. You can't grow out of it. This is not something that, okay, I'm going to spend 7 or 8 weeks on this, and then I'm going to hop over here and I'm going to master Fibonacci, and then I'm going to hop over here and I'm going to do a little Gann. This is not what that is. This is truly a complete, total worldview of looking at markets that you can continue to grow with, and you can use in ways limited only by your imagination and your abilities and your aptitude for what you're trying to accomplish with it. Another more good news, bad news, and I think this is good news, and most of our clients are this way. This is something that is going to take time, it's going to take study, and it's going to take effort to reach that level of proficiency where you're generating consistently positive results. That's just the reality of it. There are a boatload of ways to use this methodology. You know, in our live room, you will see in our live room various ways and trading styles among just Troy and I. Troy and I view the markets almost identically, but we quite often trade differently. You know, we have little bit different strategies, a little bit different techniques, tactics of how we trade. So there are a lot of ways this can be traded. It's not a one-trick pony where everybody needs to, you know, get on board this trade and do this and do that. That's not what this is about. So we're going to show you one basic way throughout this course. We're going to emphasize one basic way. And if the one way we're going to emphasize is master, it's more than enough for you to reach all of your trading goals. And I think that the people that are experienced in here will testify to that. You know, you can make this as simple as you want it to be, or as complex as you need it to be, or you choose it to be. Personally, I try to keep things simple. Okay, what are the basics of trading? Let's just talk about trading in general. If you're trading, to be successful, you really have 4 options. You can buy low, sell higher, buy high, sell higher, sell high, buy lower, sell low, and buy lower. Now, most people can't do all 4 of these things. Most people are, frankly, most traders want to sell high and buy low. They are, in market profile parlance, responsive traders. Responsive is a term in legacy term market profile that basically is you're fading. You're fading a market. If a market's going up, you're selling against what you think is resistance or overbought. And if you're buying a market that's trending down, that's a responsive buy, because you're buying a market that's dropping, and you're fading the drop, expecting it to turn for some reason, using whatever it is that you use. Now, we do that. We do fade markets, but we do it selectively, and when we do it, it's based on the same information every time we do it, or it should be, and why we do it. There has to be a reason for entering a trade based on one of these assumptions. If you're buying low and expecting to sell it higher, why? I should be able to ask each of you, when you buy something that's dropping, why are you buying it? And it can't be just because it's going down and I think it's going to go up. Now, most of the reasons that traders use for making trade decisions are very, very bad reasons, and they have no valid basis. One of the terms that you'll hear me talk about constantly in this course and in all my work and in the trade room is randomness. And randomness is a statistical term. It basically means it's a coin flip. It's a 50-50. It's random. And most traders, the overwhelming majority of traders, are random traders. They may think they have a methodology, but the reality is that just because you are using some things doesn't mean that you're not a random trader. So let's talk a minute about why it is so difficult to trade. The industry, I mean, it's common knowledge, and it's thrown about all the time that, 90% plus of the people that try to trade fail. That's the industry figure. I mean, you can call your brokers and they'll tell you that. So if the industry itself is telling you that, why is that? Why is trading so much more difficult than becoming a physician? We have at least one physician in here tonight. Is it that much more difficult than being a physician and being an engineer? Are traders just, as a group, stupid? And the answer to that is definitively not. The traders as a group are extraordinarily accomplished, bright people, and they come from all walks of life, but they also come from the sciences, the backgrounds, the engineers, the physicians, actuaries, and mathematicians are inherently drawn to trading. And those groups of people are no more successful than the educators and the salesmen and these other people. There's no correlation between profession or intelligence and successful trading, or not that I've seen. As a matter of fact, some of the brightest people that I have worked with have been my biggest failures, and maybe that's just me. Might say more about me than them, but don't think for a second that if you manage to turn on your computer and log in tonight, you have passed the IQ test needed to trade. So what do other professions have that the trading profession does not? 90% of the people that are operated on by physicians don't die, and if they did, don't you think that we'd be taking a look at what's being applied and what's being taught? And what about graduates of engineering schools? Now, I realize not all engineers build bridges, but that's the stereotypical thing. What if all the engineers, all the bridges that they built collapsed? Well, we'd look at the material, wouldn't we? and I just couldn't resist this one. But the point of this is that there is an incredibly high failure rate among traders that can't be logically attributed to the inability to grasp sound concepts. Now, I think that one of the things that works against traders being successful is how we learn. And I think it really works against the most successful people, the people that have achieved the most in their life. Because think about it. From the time you're 3 or 4 years old, you're put in a car and you're taken to a place and you are taught. And you're taught by someone that is the expert. And you follow that process from the time you're 4 or 5 years old all the way through graduate school, whether you have MDs, PhDs, or bachelor's degrees or high school education. We're taught, and we're taught about learning. And what we're taught about learning is that if we want to learn something, there's an expert somewhere, and that expert is going to give us material to study. And then we're going to take that material and we're going to apply it. And we're going to take a test. And if we take that test and we don't do well, then we got to study harder. We have to go get help from the teacher, and we'll continue and we'll progress that way. So when we start trading, what do? Well, we go find an expert, and that expert gives us material, and we study material. We try to trade it, and it doesn't work. We go back to the expert and say, this isn't working. And they say, well, you need to take this course. Well, okay, I'll take that course. All right, now I'll take this course from this expert. I take this course. I try to trade again. It doesn't work. I go to the expert. So finally, you know, you say, well, gee, maybe I just don't, this material, this isn't for me. And my buddy over here told me about this guy that he's in his chat room, and this guy's, great, and everybody's making money in the chat room, so I'm going to try him for a while. So this goes on and on and on. You go from one expert to one expert to one expert. And finally, and it happens at different time frames for different people, it begins to dawn on you that nobody knows what the hell they're talking about. It's not you, it's the material. I'm the first one to tell you that trading is difficult to do, but I also tell you, if you apply yourself and you spend a year with us, you should be on your way to where you want to be in 12 months. You don't have to spend 5 years. If you're spending 5 or 6 years on something, it ain't working, and you need to stop. Now, everything is not for everybody, obviously, and I understand that too. So what does learning to trade require? We have to have something that works. It has to have some validity to it to begin with. I'm an expert in a ton of things that you can't trade. They don't, from a trading perspective, from a making money perspective, they don't work. You really need something that has a logical foundation, something that's not based on unicorns and pixie dust. And the reason for this is because if what you're trading has a logical foundation, then if and when the wheels come off, and they will, you can go back and you can go step by step backwards to the touchstone of what you built your trading plan on, and you can work forward and you can work out what's going on. And then obviously you need material that effectively and thoroughly explains the methodology. And then, not least of all, you need work, practice, study, and experience. There is a learning curve in trading that cannot be eliminated. It can be shortened. The learning curve is going to be different lengths for different people. But the equation of work, practice, and study holds true for everyone. Okay, this is a question that I'm occasionally asked if I haven't already brought it up myself with people. Does everyone that I have worked with succeed? And the answer to that is no. Not everyone that I have worked with succeeds. And I hate that, but there's really only so much that I can do about it. I have a job to do, and one thing that I will promise you, if you are a client of mine, that I'm going to do my job, and I'm going to work very, very hard to help you succeed. And I will go to quite the length to help anyone that's serious about trading. So we've sort of covered this. It's not intellect, it's not formal formal education. It's not prior professions. And contrary to what is very popular to promote now, it's not, for traders or people that were institutional traders. We have I have 4 traders as clients, and I love them. But they'll be the first ones to tell you that trading in front of a screen and trading on the floor are completely different animals. We have former institutional traders that were on trade desk performing different market-making functions, and they'll tell you trading in front of a screen is completely different than being an institutional trader. Engineers are drawn to trading like moths to a light bulb because it's math. And engineers all want to put everything into an equation and solve it. They're no more successful than anybody else. Gender, more men are attracted to trading than women, but quite frankly, I think women as a group are probably better traders, and this is totally anecdotal on my part. And I think part of the reason for that is men's egos get involved. And women tend to be more rational and calm-headed and don't take things, don't get in this competitive mindset with things all the time. I've had a interesting awakening. My wife, and you guys hear me talk about my wife a lot, but she is a corporate tax accountant, and she manages a fairly large tax department for a very, very large company. And she works with, I would say, 75% of the people that she works with are women. And it's very interesting to hear her stories and then to listen to her talk on the phone sometimes, because, the way that the women get things done versus the way the men get things done, it's really fascinating to sort of be an insider and see what goes on. And it sort of opened my eyes, and it makes me think about trading. Now, fortunately, I do have women clients, and so we can all benefit from that, I think, and I hope. I do think, and I've read this before, I mean, I don't have any statistics on it, but I think women may have an inherent advantage because the testosterone thing doesn't get in their way. Now, I got to the point several years ago. I started Alexander Trading 9 years ago, and I'd been trading for 19 years before I started Alexander Trading, and I traded in various capacities for years. But it was a very, very different experience when I began formally working with people, and people were paying me to teach them how to trade. And, it's one thing to know you can trade. It's another thing altogether to teach something to someone else, whether it's a golf swing, a tennis swing, or anything else, because you have to take what you know and be able to articulate it. And so it has made me a better trader, actually, to teach trading. But over the years, I have, from working with people, I've been fascinated with the different personality types, and I've also tried to figure out who's going to succeed and who isn't going to succeed. And I'm not making this up. This is honest to goodness. It is. I cannot be more serious about this. I have had people pay me tens of thousands of dollars to teach them to trade, and then they will not do basic, simple things that I've asked them to do and that I've shown them that they need to do to trade. It's like they want me, they pay me all this money, and then they're sitting there and they want me to give them a 2 or 3 sentence, magical statement about, okay, now just do this. Here's the secret. And that's not what trading is about. I have never had, knock on wood, I have never had a client, I've never had a mentoring client that did what I asked them to do, that didn't succeed on one level or another. The difference between the people that succeed, in my experience, my clients, the people that succeed and the people that don't succeed, the ones that succeed do the work. They do the little mundane things that we talk about every day that cumulatively gives incredible, profound information to the individual about their trading. This is not something, I don't want you sitting there waiting for me to deliver this thing to you. I'm going to guide you. I'm going to, hopefully, I'm going to help you begin to develop a different mindset about trading and a different worldview about trading, and then show you some ways to apply it. But it's going to be up to you to take this information and take this work and this material and work it out and do the work. And I'm going to show you some things you can do, and I'm not talking about anything that my 15-year-old couldn't do. Just do the work. It's going to take some time. It's a little organization. But if you do those things, this is magic. I mean, this is the pixie dust. It is magical if you will do the work. Okay, the people that do the work are the ones that succeed. And trading is, to me, it's elegantly Darwinian. Only the truly capable succeed because there's no place to hide. You can be super bright. It's not enough. You can be super charismatic. It's not enough. You have to do the work. You have to develop an edge. If you don't have an edge, if you don't have a positive expectancy in your trading, you're going to fail. It is a mathematical certainty. So what you've got to do, you have to do the work to find and refine your edge, and you will succeed. And it's a process. It's not something it's not something you're going to accomplish and be done in 7 weeks. But what this course is intended to be is the foundation that is going to facilitate that entire process, and that will lead you, by the time you get through these 7 weeks, you're going to have enough information that if you do the work, you will be able to successfully trade in your own time if you do the work. How long that takes is going to vary between, depending on the individual. Now, this is something that I didn't advertise because I don't like to, the marketing thing has always been somewhat vexing to me about marketing a course and all the stuff that you're supposed to tell people you're going to do and give and bonuses and this, that, and the other. And quite frankly, marketing has to be done. It's something I'd rather not do, but it's a reality of having a business. So you either market or you don't have a business. So, but I didn't market this, but it's because I want serious traders, and you guys, you have qualified yourself. So if you will record the trades that you take for the duration of this course, and I'm going to show you what I want in a minute. At the end of the 7-week period, if you'll send me your records, your trades, I will review. We'll have a WebEx session with each one of you that does this, and I'll give you sort of a mini little mentoring session on what you're doing, and we'll have a discussion. I'll record it and send it to you, and that will be sort of the grand finale of the culmination of the work that hopefully you're going to be doing over this course. Now, if you're, I don't care if you're paper trading, that's fine. As a matter of fact, I suggest that you paper trade this if you've never attempted to trade. You're going to be changing some things, hopefully, and so I wouldn't be changing things with real money. Paper trade, but take it seriously and record the trades that you take. So if you will send me your trades at the end of the 7-week period, I'll make an appointment with each of you, and we'll have a private little mini mentoring session. Now, this is what I'm looking for. Well, let me go back to this. Do the typical spreadsheet thing: date, asset, win, loss, the total, cumulative, okay? But just put that in a spreadsheet. And then this is just as important. I want an annotated chart. I want to emphasize that I can read. If you use black screens, don't put red type on it and send me this teeny little GIF file. I'm not going to do that. I'm not going to go blind trying to read it. It's got to be something I can read. It's got to be something like this. And this was from yesterday. Actually, this is a trade I actually took. It worked, as opposed to the trades I took today that did not. So I have losers too. But this is an example. Sold the ES at $14.99. Initial stop was $15.75, just above the Globex high. This is an example of a responsive trade. This was a little balance area, and I sold it in here, and it really shouldn't have gone any higher than the Globex high, and it didn't. And then it reached this target down here, which was this low, and I trailed the stop and got taken out. And then this was chop. This was noise. There was no reason to do anything in here. The market stayed below the upper extreme and above the lower extreme of the day the rest of the day. You don't trade. There's no edge in here. The edges are at the extremes, but we'll get into that later. Now, Troy brings up a good point here. Be honest and include all trades, winners and losers. The losers can be the best ones to learn from. Absolutely. You guys will see me explain trades that I take periodically, and most of the time you're seeing me explain my losers because I think those are the most important trades, number one. And number two, it's important for you to realize I'm not sitting here as a trader just minting money with every single time I take a trade. I'm making huge profits, and I have 99 out of 100 winning trades. That's not the reality of trading, mine or anyone else's, contrary to what you see in your email box every night. Okay, let's spend some time talking about things that have to be avoided. Overtrading. Almost everybody that I come in contact with as a new client overtrades. And overtrading, these things that must be avoided are symptoms. They're not the disease themselves. They are symptoms of a bigger underlying problem, and that's the problem that we're going to cure. But the overtrading thing is a symptom of not understanding markets, not understanding the markets you're trading, whether it's the S&P or corn or Apple stock. Traders generally have anxiety all day long. They're sitting there and they're anxious constantly. They're in a dither over being out of the market when they're out, and let's take the S&P as an example because it's at least familiar to everyone. The S&P goes up 3 handles and a trader in it, they start freaking out, and they either start chasing it or fading it. And then as soon as the trader gets in that market, then the trader becomes anxious because he's in a position, doesn't really know why, except it was going somewhere without him. But now he's in it, and it's slowed down for 30 seconds, and I don't know, where do I put my stop? Do I take it out? Now I've got 3 ticks. Do I take, So it's this constant anxiety over I'm missing something, or I'm in, and I don't know if I really want to be in. And if you're sitting there, and this is a feeling that you have every day, day after day, trading is going to be a really, really miserable experience. This is randomness. I don't like having losing trades, but it's part of doing business, and I understand it. When I took some trades this afternoon, and I described them in the room, took them for perfectly good reasons. I would take them again. They didn't work. End of story. Okay, using too much leverage. Any edge. Let's take a hypothetical, and this is hypothetical. Let's say you have a 60% chance of when you commit risk, you have a 60% edge. So, 60% of the time you're going to generate 30% or something like that. If you over leverage, it's not if you're going to blow up, it's a mathematical certainty that you will. And institutions blow up constantly. Hedge funds blow up constantly. Retail traders blow up constantly. Banks blow up constantly. Governments blow up. That might not be a good one to get into right now, but leverage is a double-edged sword, and there's a really, really, really bad idea that's out there now, and there are several popular gurus that do this, parlor card trick where they'll, do a webinar and they'll put on, 25 whatever euros or DAX or the S&P and trade it for 3 ticks and say, oh, wasn't that easy? Oh, that's all you got to do all day long, in and out, 3 ticks. Well, that's great if you have extraordinarily deep pockets. The loss that you're invariably going to take doesn't matter. And, but that's not a way to sustain a career in trading. the inverse of this is how professional people trade. The people that I know that sit off by themselves. You're never going to hear about them. You're not going to see them. They're not after publicity. But they'll tell you, you want to make as much money as you can using as little leverage as possible. That way you don't get in trouble. You can make a ton of money trading using very small leverage. You have to be patient. You have to be disciplined. But the leverage thing will kill you. Most people over leverage. You're not. It doesn't make you a pro to trade 50 S&Ps. That's not your goal. Your goal is to trade 2, 3, 4, 5 S&Ps and have a smooth equity curve with relatively small drawdowns. If your returns have a high standard deviation, if they vary a lot from up to down, that's a sign that you're over leveraging, and it's a sign that you're in danger of blowing up. So the idea about, I've got to get to the point where I can trade 5 S&Ps or 10 S&Ps, no. You have to get to the point where you know how to trade 1 S&P, because that's a rare place to be, because so few people know how to trade 1, much less 50 or 100. If you learn how to trade 1 contract, you're a superstar, trust me. And then it's not a big deal to trade 2 or 3, but you never want to get to the point where you think, okay, I'm a pro, I'm going to trade big size. That's a big, big, big mistake. There is a book, and I know a lot of you have read it, I've mentioned it before, called When Genius Failed. It's the story of Long-Term Capital Management, which was a hedge fund. I think it was 97 or 98. Somebody like Pierre, I'm sure you read that. But it's about guys that started this hedge fund in Connecticut, and 2 of them were Nobel laureates. And one of them was I think it was Scholes, the option pricing guy. And I can't remember. Oh, was it somebody else? I can't remember. And then John Merriweather, I think, was part of that crowd too, who's still not in money. So now that's an example of very, very, very smart people, geniuses, quote unquote geniuses, over leveraging and blowing up. And they almost took down the Western financial system. The surest way to get rich quick is to do it slowly. So what if it takes you, not 7 weeks, okay? So what if it takes you 7 months to develop the confidence that you can take a contract or 2 and at the end of every week be profitable? So what if it takes 7 months? If you're expecting to do this in 7 weeks, you're not realistic. And in the big, big picture, if you can do this in 7 months, you've got, the world is your oyster for the rest of your life. So, make the best use of your time and commit to doing this the right way, and don't get over eager or anxious because you're not where you think you need to be. I mean, 7 months, 8 months, 9, 10, 12, 13, 14. I mean, does it really matter if at the end of the process you have the confidence and you have the data that proves that you know what you're doing? Okay, things that must be avoided. That was a nice segue into unrealistic expectations. There is a learning curve in trading. It cannot be eliminated, only shortened. The trading industry is built on a promise of totally eliminating that learning curve. It's as if it doesn't exist. There's no mention. Just come in here and we're going to show you what to do. And all you have to do is listen to us and piggyback our trades in our chat room, and you're going to get rich. Well, try that. Try it and get back to me. It doesn't work. Those people can't trade. Anybody that says something that's stupid, I promise you can't trade. There is a learning curve in trading, and actually one of the quickest things you can do, or one of the best things you can do to shorten that learning curve, is to realize that there is a learning curve. At least acknowledge it. You can't go buy a pill that's going to make you a successful trader. You can't read one book. You can't look at one course. You can't sit in one chat room day after day and expect to learn to trade. There is a process involved. There's a learning curve. And this material is part of helping you to eliminate some of the time of a learning curve. And part of the reason it takes so many people so long to learn to trade it's not that they've tried to trade for 7 or 8 years and they're just, too thick to pick it up quicker. It's that they really don't have 7 or 8 years of experience. They have 1 year 7 or 8 times, because they go from here to this, to that, to this, to that, to this, and then they mix and match, and et cetera, et cetera. And a lot of you know what I'm talking about, because we've all gone through that to one degree or another, hopping around, trying different things. It's just the way we wired, I guess. If you have little or no experience trading, don't trade with real money. Study, sim trade. Put yourself in a comfortable position to learn. Put yourself in a psychologically comfortable position to learn. If you're sitting there and when you take a trade, if you care whether or not you make or lose money on that trade, about the money, then you need to be sim trading. Losses and gains are just part of doing business. You have some losses, you have some gains. At the end of the week, you want to be profitable. Now, trading can be extraordinarily frustrating. Don't think for a minute that I don't get frustrated and upset and mad and blah, 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 all that other stuff. I'm not Yoda, trust me, sitting here trading. I get upset too, just like you guys do. That's not what I'm talking about. But if you're sitting there obsessed with the next $100 or 200 or 2,000 or whatever it is, then that's telling you that you don't have any business at that point in time trading real money, because you haven't developed the confidence to know what you're doing, even if you do know what you're doing. So, give yourself some time to prove to yourself and put yourself in a psychologically comfortable spot where you have legitimately earned the confidence that you're going to need when you start trading real money. And what I'm suggesting to you may not be what you want to hear, but it's the quickest path and the most painless and cheapest to becoming successful as a trader. Okay, under the things that must be avoided, doing anything that almost everyone else is doing. What sells in this business is not what works. The trading industry is unique in that what is in the industry's best interest is not in the interest of its clients, especially the retail client. Maybe the exchanges are far more interested in facilitating the needs and the desires of the larger institutions than they are the retail trader, believe me. And that's fine. I get that. I totally understand that. But you just need to be aware of what this industry is all about. This industry is based on a transaction model. It survives on transactions. The more transactions, the more money the exchanges make, the brokers make. The magazines, the books, the trading education business is built on this quick fix transaction. Let's do a lot of trading. I'm going to show you how you can come in tomorrow morning and while you're eating your oatmeal, and by the end of the day, you've got all these profits, and it takes 15 minutes a day and all this nonsense. Those are real popular things. They're very appealing things. Who wouldn't want to have traded and completed their trading by the time they eat their oatmeal in the morning, or bacon, or whatever you're going to eat for breakfast? Well, it doesn't work that way. But it sells, so there's a lot of it out there. It is not popular to tell people the way trading really is, and I know this. I know this very well. Something else that needs to be avoided is an overemphasis on comfort. Comfort is another thing that sells. We all want to be comfortable. None of us want to be uncomfortable. And, it's uncanny. I have these conversations with people that call me up and ask me what we do, and, what's your track record in your room, and, all the standard questions everybody asks. And I'll start to talk about, what we're doing and holding trades, and then I'll invariably get, well, I'm just not comfortable doing that. And, there's room in this methodology, and there's room in any time frame you trade to fit your personality. But the comfort thing is so overrated, that especially as you learn to trade. It's sort of a travesty. you've got to learn how to do this. And some of the things that you need to learn to do are probably not going to be comfortable. It's uncomfortable for most traders just sitting there and doing nothing all day. Think about it. Can you sit there and not take a trade all day? Can you sit there and not take a trade for 3 hours? That makes a lot of people uncomfortable. Well, that's one of the primary things that you can immediately learn to do that will improve your trading. If you didn't do anything else except trade less, it would probably improve your trading. So let's not confuse comfort and developing a trading style that fits your personality. And develop is a key recurring concept in this course. It takes time, and time is a key concept in this course. It's a key concept in auction market concepts that you're going to be immersed in over the next 7 weeks. But back to the topic at hand, it takes time to develop comfort when you're learning something new. I mean, was it comfortable when you began learning algebra or calculus or chemistry, or when you first began learning to hit a golf ball or a baseball or a tennis ball or ride a horse? Name something really worthwhile that was initially comfortable. Swimming, riding a bicycle. I could go on and on and on. Most things require, that are worthy of accomplishing require the ability to overcome some initial discomfort. What are some simple steps that you can immediately apply that's going to improve your trading? First, please commit to giving this course your full effort. We're going to put a lot of effort into getting you material, not just the course material, but a lot of supportive material, the room, the reports. All of these things are, especially you new guys, all of these things are part of the experience over the next 7 weeks, that if you will avail yourself of these resources, I think you'll get out of this what there is to be had, which is a lot. Trade less, watch more. Not trading is trading, and it's grossly underrated. One of the biggest edges a screen-based trader has is hardly ever used. And that edge is the ability to sit there and do nothing. And part of the reason for this, again, is the insidious message from the trading industry itself that if you're a trader, you're trading, and being a trader and trading means clicking that mouse. I want to trade, 4,000 S&Ps or 400 S&Ps or 15 trades. I did 70 trades today or whatever. You have a huge advantage as a screen-based trader being able to sit there and pick your spots and let that market set up into its highest probability time and price area and take your trades. You've got to define what you're doing, and this gives you the means to do that. Now, most traders overtrade, and they don't watch because they don't really know what they're watching for. What they end up seeing is the market either moving away from them, and then they get in, and then all they see is the market retracing against them by some amount that they have fixed in their head that they can't afford to lose. I can't afford to lose but $75 in the S&P mini, so my stop has to be 6 ticks. Well, that's not going to work. The market doesn't care how much you can afford to lose. You have infinite opportunity. There is, I've been trading 28 years, and there is opportunity every day I'm sitting in front of my screens. When I first started trading, I was certain that, I don't know why you have this mindset, but it's almost like the market's not going to be there tomorrow. I've got to make this money today. I've got to get this trade today. Get used to missing trades. This gets back to the comfort thing. Get comfortable missing a big move. Sit there and go, wow, I sure wish I'd caught that. You'll hear me say this all the time in the reports and all the time in the room. I'll go, golly, I sure wish I'd caught that. I miss far more than I catch. You guys have a lot more of an ability to watch the markets and more markets than I have. I'm answering the phone. I'm, doing 1,000 things in here, but in addition to trading every day. I miss stuff all the time. It's okay. You eventually get comfortable with that. So that's something else that you can work on getting comfortable with. Sit there, and if you think a market is going up, let's say, give you a hypothetical, and it starts to go up, but you missed your entry, well, sit back and say, okay, now what did I miss? Or was this just something that just happened, and you know what? I'm going to miss that trade every time. Because there are moves in the market, and you guys will hear me say this. There's certain things that a market will do that I'm going to miss. A lot of it's out of choice. I'm not going to try to do certain things in the market because for me they don't work. Some of the things are things that don't work for anyone. Some of them are unique to me. I just can't do that. It just doesn't work for me, so I don't do it. So you'll get used to sitting and watching, and you're going to get more selective, and that takes time. It takes time to develop the comfort level to miss things, but rest assured, you're far better off missing opportunity than you are chasing things and trading randomly and losing your money. There is an endless, never-ending supply of opportunity. You can afford to miss it. I don't think you can afford to lose most of your money. Start paying attention to longer term charts. Now, what's longer term? Well, a longer term is a relative term. I'm going to show you, we're going to look at some monthly charts tonight. And those monthly charts have dramatic implications for day trading tomorrow. Monthly charts have dramatic implications for day trading tomorrow. That's something else that's different about our worldview as auction market traders. It's contextual. Tomorrow, we don't really look at tomorrow as a discrete event. Tomorrow is a piece of what's been going on here for weeks, days, years, etc. And we are at a long-term, multi-decade inflection point right now in the equity markets. It's an extraordinarily exciting time, yet another exciting time to be a trader. So this, if some of you are sitting there scratching your head now going, what have I gotten myself into? This guy's talking about monthly charts. There ain't no way I'm trading from a monthly chart. That's not what we're talking about. Actually, it might be a good idea to trade from monthly charts, but that's just one time frame. You want to learn that the market is not just 9:30 to 4:15. It's the 9:30 to 4:15 is a piece, and it's just a continuation of what happened in Globex, which is what happened today, which is what happened yesterday in Globex, etc. So the context that you're going to learn begins by developing an awareness of the bigger picture. I'm not telling you not to day trade. Everybody in this room, to the best of my knowledge, day trades. I day trade. Troy day trades. Most of the people in this room day trade. So it's not about, I'm not telling you, oh, you can't day trade. You've got to look at weekly charts and trade from those. There's nothing wrong with that. But if you day trade, you especially need to look at longer term charts. And that is also something that will give you an inherent edge. And let's talk about edge just a bit. This is not part of this particular session. We're going to talk about edge later specifically. But an edge is a combination of things. And a lot of them are not necessarily the tangible things. It's how you look at the market. It's the time frame you trade. It's sitting there and looking for opportunities opposed to chasing things. So you can immediately begin developing an edge and increasing the probability of you developing an edge in your trading by beginning to do some of these things now by looking at longer term charts and being aware of a bigger picture that you're trading. Okay, begin watching more than just one or two markets. The S&P, the stock indices. Well, I'm actively trading the stock indices more actively than I have in a while because they're moving. But sometimes they don't, and that'll happen again. Sometimes you're better off trading the euro or the Australian dollar or the British pound or corn. I mean, there was a period actually of several months where we were trading the grains actively, and Troy was in the room constantly. You know, a lot of you guys got great grain trades. You know, this is being an opportunistic trader, and a lot of reason people don't look at different markets is because, once again, they don't have a basis for it. They think that, you know, there's the S&P, and then there's corn, and then there's the euro, and they don't have anything in common. And you know, I can't trade. I have an S&P trading system that doesn't work on the euro. Well, if you have an S&P trading system that doesn't work on the euro, you probably don't have a valid S&P trading system, but that's another story. What we do is extraordinarily robust. It works in any market and in any time frame. The examples that you see are going to include many different markets. So they'll include a lot of the stock indices, bonds, notes, gold, silver, copper, grains, all of these things, and that should be exciting. Now, I'm not suggesting that you tomorrow, you know, you take a trade in gold or crude oil for the first time ever. You need to understand that some of these contracts are richer, so to speak, than others. In other words, there's more leverage in them. But the fact is that the trade setups and how those markets develop from an auction market perspective are all identical. And if that's the case, then you have a wonderful opportunity to, instead of forcing trades every day in one market in one time frame like the S&P Mini, if we get into some sort of protracted balance area in the S&P and it's just not set up, it's in the middle of a 10-day range or something, go look at copper, or go look at the euro or the Australian dollar or crude. And one of those markets every single day has a great trade in it. And Troy in our live room does just an inhuman job every day of finding things that set up in a manner that they're based on the trades that we take. These setups that you will learn, and I hate the term setup, but you know what I mean. These things recur over and over again. And we are going to show, quote unquote, setups, but that's the least important thing you're going to learn. You will learn setups. Okay. For the next week, actually, should be for the indefinite future. Every time you take a trade, just do these exercises. Even if you're not going to send me your trades, a lot of people don't feel like they can't show me their trades because I'm going to scream at them or something. I might scream at you, but hey, if you want to get better, then no, I'm not going to scream at you. But if you don't want to send me your trades, do it for yourself. So start writing down, when you take a trade, put yourself on the spot. Why? You say, Tom, why did you enter this trade here? What was it a good? Are you sure you wanted to enter this trade here? What was the reason you got out? You got in this trade, and then you took 6 ticks profit, and the thing trended all day long. Well, what were you thinking? Why did you do that? And if Tom's answer is, well, my oscillator was overbought, and so I thought it was going to turn down. Well, then if that's your answer, and that happens over and over again, then it might be telling you something about what you're using. So if you are using things that are not working, then let's not use them anymore. Now, if you have some magic oscillator and you're minting money with it, by all means, continue to use it. And you share it with me. I'll use it too. But be honest about what you're using and how you're using it and why you're using it, and keep a record. Put it to the test. And if you can't do this, if you don't know what you're doing and why, or you have 1,000 different reasons every day why you do or don't do something, or where you get in, where you get out, and why, then you're a random trader, and you cannot be a random trader. You want to, if you're consistent, if you're doing the same things over and over and losing money, and you know what they are, at least you have a basis for understanding you don't want to do that anymore. If you don't know what you're doing and you're not keeping records of it, you're lost, and you can't, you're trapped, and you can't escape. So you have to know what you're doing in order to change it. This is not a methodology. Before I started Alexander Trading, one of the right before I started Alexander Trading, I had a GIB. I was a broker, and 99% of my business was institutional, but I had some retail business, and I had some accounts, and a few accounts. I don't think I ever had a total in 4 years. I don't think that I had the GIB. I don't think I had a total more than 75 or 80 accounts that entire time. But anyway, people would say, well, can you help me with my trading? And I'd say, well, yeah, I'll be happy to if I can. I said, well, do this for me. Send me your chart and, show me what you're doing. And without exception, every single chart I would get would look like this. I couldn't, it would give me a headache to look at it. And this is how most traders' charts look. And I'm not going to get into it tonight because it's a specific topic that I want to cover about indicators and why people use indicators and what those indicators are. But first of all, most of them are redundant. Every indicator you see on this chart is giving the same information. They're redundant. But I always get a kick out of people's charts to this day. And that's something else. When people come into our room, especially if I show my charts and I put up a bar chart, and they're looking at it going, well, where's the stuff? Where's the market going to go? So I want you to do this. I want you to examine the tools you're using. If you're using an indicator, write down what that is. If I ask you right now, what's a stochastic? How is it? What's the formula for stochastic? What drives that stochastic? What makes it go up or down? And contrary to popular belief, indicators don't lead the market. They can't. It's absurd. Indicators are derived from price activity. Indicators are a number series. They're a moving average number series that generally have some sort of boundary and smoothing or exponent. So understand what you're using so that you know what it is. And then write down what they're telling you and why they're telling you that. Write down what this thing that you're using is telling you. And then write down how it tells you that. And then write down the reasons you're using these tools. You've got to learn what you're doing. You need to know what you're doing and why. And you can put me and this material to the same test. Okay, we're going to go through the background and evolution of market profile. And I can't overemphasize this strongly enough. We are not market profile traders. We are auction market traders. You do not want to be a market profile traders. There are a bunch of market profile traders. There are no profitable market profile traders. Now, the market profile graph is a tool. We use it as a means to an end, but we're using it to give us information about the auction market. We're not using it as an end in itself. It cannot be effectively used that way. And most of the time, you really need to use the bar chart with the profile chart. There are times where you get a better view of the auction process on a bar chart. There are times where you get a more obvious view of what the market is doing on a profile chart. Over time, you'll be able to look at a bar chart and you'll know what a profile chart looks like, that the corresponding profile chart looks like. It's very difficult to look at a profile chart and know what the bar chart looks like. And if that confuses you, just hold that thought. We're going to spend a lot of time talking about those two topics because it's very, very important to learn how to use and how to read both of those charts through this auction market lens that we're going to teach you. Okay, now the background and evolution of market profile, it can be traced back to Chicago in the early 1980s, and there are three primary individuals that have popularized market profile: Peter Settlemyer, Jim Dalton, and Don Jones. And by far, Peter Settlemeyer and Jim Dalton are the best known. I'm going to talk about, I really can't talk about one without talking about all three of them. And this, you're going to learn something tonight that very, very few people are aware of about the evolution of market profile. Now, let me explain, take you through my history with market profile. I began trading in 1985, and I have more stories than you want to hear about trading and my experience trading, but suffice to say, I was very enthusiastic. I was a stockbroker. I became a stockbroker in 1985 and hated it. Just absolutely hated it. But man, I loved the markets. And I can remember cold calling. I did the cold calling thing. And I can remember a specific phone call. And, you know, even this was the mid-'80s. And, you know, cold calling was not popular even then. But I'd call somebody up and, you know, interrupt their dinner and, and stuff like that. And one time this guy answers the phone, and I said, you know, Mr. So-and-so, I have an investment idea. Would you like to hear it? He says, sure. I said, oh, wow, I've got one here. So I start telling this guy about something. Let's call it IBM. I don't remember what it was. And, you know, he listened. I went through my entire spiel on buying IBM and why, you know, what it was going to do. And it's trading at 87 now, and we've got a target of 120, and it's a great time to get on board. You know, can I put you down for 1,000 shares? You know, you close the guy. And the guy at the other end of the line, he doesn't say anything. He says, why don't you buy it? I said, what? He says, well, it's at 87. It's going to go to 120. Why don't you buy it? I didn't have a good answer for that. Besides the fact that I didn't have any money. But it made me think. And I thought to myself, well, yeah, hell yeah, why don't I buy it? If it's going from 87 to 129, sign me up. I'm going to buy it. So I started thinking, hey, maybe that's where the real money is made. So, you know, the selling stuff to people wasn't as much fun, especially if, you know, I'm someone I really have to, I can sell you anything, but I have to believe in it. So I started thinking, well, gee, if this stuff is going to go up, I need to figure out how to buy it. Well, I didn't have a lot of capital. So I started trading options. And back in the, when I started trading, the OEX was an index option. It's the S&P 100. It still trades today, but the OEX was the S&P mini of the day. Futures had come out in 1982, and I didn't start trading the S&P until about 88. So in 85, I started trading the OEX options, and I ended up trading very quickly. I was trading hundreds and hundreds of OEX options for my own account every day. I had a computer sitting on my desk with one of the first iterations of an option analytic software that gave me the Greeks, and I got all into the options thing. This was the program was OptionView. It's still out there today, and I would download by hand the option chain into my program so that I could, you know, get the different Greeks and the deltas and this, that, and the other. But I was basically just, you know, gambling. I was buying bunches and bunches of out-of-the-money calls, and primarily out-of-the-money calls. I was always long, and out-of-the-money puts. Well, what happened is that as soon as I started trading, I decided, well, if I have, you know, a $5,000 account, you know, I don't want to buy these options that cost $3. You know, I can't buy very many of them. I want to buy these options. And this was when you could buy options for a 16th. We call them a teeny. You know, you could buy options for $6. So instead of buying an at-the-money option and paying, you know, $1.50, $1.75 or whatever it was back then, you know, I'd buy 600 out-of-the-money OEX calls for, you know, $6 or something like that. Well, I did this, and unfortunately, the market took off, and I took a small sum of money, and in about 6 or 7 weeks, I had run a small sum of money into more money than I had ever made in my life in any 2 years combined up to that point in time. Well, I immediately attributed my success to my specialness and how smart I was and what a great trader I was. And I was on my way. I had taken this money up into the, you know, I think I'd run $5,000 to $60,000 or $70,000. And, you know, I had, and then of course in my mind, I'm extrapolating that rate of return out, and I'm thinking, okay, in 4 years, I'm going to buy Harbor Island over here in Tampa. I lived in Tampa at the time. Well, you know, the rest of the story is that that came to a screeching halt, and I gave all that money back and more. But and then I've got stories about trading the market crash too. I was actually short the market in 1987 when it crashed and lost money. That's another story. I'll save that one for you. But anyway, so I eventually figured out that I didn't have a clue what I was doing, and I had better figure it out. And so, you know, I've always been one of these people that gets, if I get involved in something, I get completely immersed in it. I don't care what it is, whether it's, you know, when I play baseball or fishing or hunting or tennis, anything that I get involved in, I just, you know, I just leave no stone unturned. And I was that way with trading. So I, you know, I called all the gurus and subscribed to, you know, the relatively few newsletters that were out available at the time, nothing like it is today. But back in 1988, I started using CQG as a trading platform. And I was looking through CQG one day, and there was this thing called Market Profile. So I click on the button for the Market Profile indicator, whatever it was, and it, you know, prompt came up that says you'll have to contact your representative, you know, to get this. It cost money to, you know, it was an add-on. So I called my rep and I said, Becky, what is Market Profile? And Becky says, well, it's a charting thing. And that's, I'm literally, it's a charting thing. I said, okay. Well, she said, you want to try it? Because, you know, you can try these things for a couple of weeks. I said, sure. She says, okay, I'll enable you for it. And it'll, you know, in 30 minutes, you can pull it up. So she enables me. I hit the Market Profile button, and my bar chart turns into these letters. Now, what in the world is that? So I call her back, and I said, Becky, what is this? She says, well, that's Market Profile. I said, yeah, but what is it? I said, it's a bunch of letters, and it's these, you know, shapes and stuff. And she says, well, hold on a minute. And so she comes back, and she says, well, you know, there's nobody here that can tell you what it is. I said, well, where did this come from? She says, well, it was, you know, there's a guy named Peter Settlemeyer that's friends with, and I forget the guy's name that owns CQG, that's friends with so-and-so, and it's his, you know, invention. He's the one that did it. I said, well, you have a phone number for him? She says, hold on. So she comes back, she gives me Stellemeyer's number, because I would, you know, I would call anybody. So I pick up the phone and I call Stellemeyer. And now I've been trading about 3 years and thought I knew what I was doing, or thought I was beginning to know what I was doing. So I call Stellemeyer up and I start talking about Market Profile, or ask him what it is. And he starts talking with me about Market Profile. Now, I don't know how many of you have ever heard a lecture by Peter Stellemeyer, but it's unique. And let me say this, I have incredible, enormous respect and admiration for Peter Stellemeyer and for the work that he has put out into the public domain in beginning this process of how to view markets. He was the beginner, the originator of it. But he has one of the more abstruse means of communicating of anyone I've ever tried to listen to. And I'm not the only one that says that. He's acknowledged it. The guy is, you know, he just has an odd way of communicating, and it can be difficult to understand the concepts that he's trying to convey. So anyway, I talked to Stellemeyer. He was very generous with his time, and we talked for 30 or 40 minutes, and he'd answer all my questions, and he would expound on this, and he would talk about that, and I'd hang up the phone, and I'd look at the receiver, and I'd just go, what? I had no idea what he was talking about. And so that was my first initiation into Market Profile, as I began to look at it and just sort of visualize and work with it and look at it. Well, Stellemeyer was a floor trader in Chicago in the grain pits, and he had a background in farming, and I won't go through that entire story tonight. Some of you guys have heard it before, but he grew up on a farm, and a farm is basically one giant auction. And so he was familiar with auctions and bargaining and dealing and value and things like that. And then he ends up in the grain pits in Chicago, and he's a visionary. He has a different way of looking at things. He's just one of these people that's cursed or blessed, as the case may be, of seeing things from a different perspective. And he was able to visualize on the floor this process of price activity during the day, and what prices tended to do and why, and what would change, what would create prices to change from the area in which they were trading then and go somewhere else. And that's the genesis of how he organized this profile graph, and we'll talk more about that. And he went to the CBOT. He was a member of the CBOT and basically gave the CBOT this work, which was extraordinary because nobody would ever give anything away like that in this day and age. So, Stottlemyre should get more respect than I think he gets for what he has given to the trading community in terms of starting the process of looking at markets differently than they'd ever been looked at before. Now understand, and this is a very, very, very important point. This is a key point about market profile. Market profile was designed to give all floor traders information about trade activity, i.e. volume, that was unavailable to the off-floor trader at that juncture. Market profile came to be at the time when the floor, the trading pits, ruled the trading world. To trade, you had to go through that floor. It was the source of information. Everything went through the floor. Remember that. Everything at the point in time market profile came to be, was initially posited as a concept, went through the floor. We'll revisit that concept, but I want to put it out there and I want you to remember it. Now, so Stottlemyre creates this incredible buzz because he's sort of a charismatic guy. He has a lot of credibility. He's a very bright guy, and plus he was one of them. He was a floor guy. So he had instant credibility in Chicago. Well, market profile became sort of a cult, and the floor traders obviously were all over it because the initial premise was that you could take market profile and you could use it to predict what the markets were going to do. There's still this incredible attempt to predict what markets are going to do. Now we know, and I'll tell you now, auction market traders do not predict. I don't predict markets. You're not going to predict markets, but we can identify trade location. We're traders looking for high expectancy levels to trade, and we'll revisit that. But anyway, the initial promise of market profile was as a predictive device, and also market profile was designed as a discrete day-to-day entity. In other words, you had the profile for today, then you had the profile for tomorrow, and then you had the profile the next day. They really weren't looked at explicitly in a combination. Now, if you read between the lines Stottlemyre's work, early work, he was visualizing a bigger auction process. But again, he did not articulate it particularly effectively. Now, Stottlemyre had an office at the Board of Trade. Jim Dalton had an office at the Board of Trade. At the same time, Stottlemyre had an office at the Board of Trade. Jim Dalton was a commodity broker. He had a commodity brokerage firm. And he saw the benefit of the buzz around market profile and jumped on board the bandwagon and started promoting Stottlemyre and Stottlemyre's seminars. He gave a series of seminars and workshops at his ranch out in California. And Dalton jumped on board because it was good business. I mean, he was a broker, and this was something value added to his clients. So Dalton, and I have a book around here somewhere, one of Stottlemyre's books, was sponsored by James Dalton and Associates Commodity Brokers, 141 West Jackson. Okay, now the third party here is Don Jones. Don Jones was a trader too. Don Jones traded, 10 or 15 years. He ran a hedge fund, and Don had a 50% return average for something like 12 years. And then the system that he was trading, and Don was a systems trader. Don is a physicist. Don is literally a rocket scientist. I forget the company he worked for. He worked for Lockheed or one of those companies out of college, but Don's a physicist. He's a scientist. Well, he's, at this point, he's winding down his trading business, and he hears the buzz about Stottlemyre's work, and Don's a scientist. I mean, has that critical thinking mind. He's the premise of market profile and the general concept, and this is why so many engineers and science types are attracted to it. They look at it and say this Gaussian shape. They think, oh, statistics, it has validity. Well, that's the same thing with Don Jones. He sees the statistical shape of the shape of a typical statistical distribution and says, let's look at this. And so there's this big buzz about market profile. Well, you didn't have charting programs then that would chart market profile for you. You had to have data, and you had to get that data somewhere, and the CBOT was the only place you could get it. But then you had to have it compiled into this profile format. Well, Don Jones starts a business, a data business, downloading the CBOT data every night and compiling it into the profiles that Stottlemyre is telling people they need to use to predict prices and trade from. So Don Jones has this big business going, supplying the students of Stellamire, and Dalton is a broker, and he's seeing all this going on. And then Dalton, and I don't know exactly where in here, but Dalton sort of breaks off and gets and hops on board the market profile wagon and decides that he's going to become and brand himself as a market profile guy. And to do that, he writes Mind Over Markets. And Mind Over Markets, most of you have read Mind Over Markets. Mind Over Markets is still to this day the Bible of market profile traders. Now, it has zip validity, but it's still the Bible of market profile traders, which is fine. And Mind Over Markets is basically a rewrite of the CBOT manual, and Dalton added some day types in it. And Dalton became hugely popular because his writing was easier to read and it was easier to discern the points he was trying to make than Stellamire's rather abstruse stuff that he was putting out there. So people were flocking now to Dalton and to his seminars and his work. Well, Dalton became extraordinarily popular, and he's writing Mind Over Markets, and he's got these ideas about how to trade the market profile graph. And he needs these ideas tested. Well, Dalton's not a computer guy. Don Jones is a computer guy. Don Jones is in the same building. He goes to Don Jones. They're buddies. You know, all three of these guys know each other. And says, hey, can you test this? And Don says, sure, if you can define it, I can test it. And so Dalton starts giving Don Jones these ideas about, okay, now what happens if the market opens above the previous day's value area and trades 3 ticks into the value area? What's the probability of a complete retracement of that day's range? And, you know, basically the setups that you see and you read in Mind Over Markets. So Dalton goes to Don to test all these setups. Well, bottom line is he goes to Don, tests his setup, doesn't work. Tests his setup, doesn't work. Well, he gets frustrated with Don. And Don says, look, you know, the computer can only test what you tell it to test. And it's not a discretionary model. It's binary. It's yes, no. It either has a rule or it doesn't have a rule. The computer doesn't understand nuance and discretionary trading. So long story short, Don could not validate through his testing the stuff that Don Jones puts in Mind Over Markets and, you know, thought had validity. Well, it was very popular nevertheless, so Dalton starts a fund. And something else, another aside here, if you look at Mind Over Markets, the authors are Dalton, Jones, Dalton. Well, the Jones is Don Jones' son, who was the editor of Mind Over Markets. So that's another piece of the puzzle here. So Dalton goes ahead, prints Mind Over Markets, becomes extraordinarily popular, still is to this day, and people still try to trade the stuff that's in it. Dalton started a fund because people were throwing money at him because it sounded so good. And basically, they shut the fund down in 6 months because it lost money because the trade didn't work. Now, how do I know all this stuff? I know all this stuff because I've spent a lot of time with Peter Stellamire, but I've spent even more time with Don Jones. I consider Don Jones to be a really good friend and the closest thing to a mentor that I've had. I have spent, I don't know how many hours over the years with on the phone with Don, and I've gone out there and stayed with Don, and he's just a delightful human being, just one of the neat people that I've had the pleasure to know in my life. Don is probably, gosh, I don't know, his mid-80s, and still, I mean, he is the real deal intellectually. He is one of the bright people. You know, there's the world, you know, we live in a world where all of us are around really smart people, but once in a while you run into somebody that's really, really smart. Don Jones is really, really smart. And I don't mean in just a geeky way. I mean, he's plenty geeky smart, but he's one of these guys, you know, I'll go to dinner with him and, you know, we'll order wine, and then he'll start telling me everything there is to know about that wine and the region it's grown and that type of grape. I mean, you know, he could tell you about the tablecloth. I mean, he's just one of these people. It's just, but he's neat. He's just a lot of fun. Anyway, so Don then begins looking at Stellamire's work more closely, and he begins looking at Dalton's work closely. And being a scientist, he's going to test things. He's going to prove or disprove things. That's his mindset. It's scientific method. And basically what Don Jones found is that the way market profile was being presented had zero validity. It didn't work. It didn't work. Now, I'm going to read you a quote from Don's book. Let me find it here. Okay, here it is. This is from Don's book, Value-Based Power Trading. Stellmeyer and a partner started Market Logic School. A system of market analysis based on profiles was taught by Market Logic School and separately by Dalton Capital Management. Hundreds of traders were drawn to these courses by the promise of learning how futures markets could be understood and mastered. The Dalton Group initiated a biweekly research report under the editorship of Eric T. Jones. That's Don's son. These profile reports investigated all aspects of the market profile liquidity data bank, and we're going to touch on that in a minute, providing unparalleled breadth and depth of information on this database. Students of Market Logic School and the Dalton Group demonstrated a willingness to do the necessary homework and study to understand profile theory. Many students continue to have difficulty in applying it to the market. Our company, Cisco, that's Don Jones' company, it's cisco.com. I'll send you the website. Our company, Cisco, had the impetus to encourage and help traders because we were a source of the CBOT data. We interviewed many traders who stopped buying our data because they could not make profile theory work satisfactorily. They reported two main problems. Within the day, they were unable to project the day's action from the developing profile to its final form, and they were unsuccessful predicting the next day's action from the previous day's profiles. What I just read to you is very profound and it's very important, and it's why you are not going to be a market profile trader. At least you're not going to be a successful one. It doesn't work, and that's what's being taught out there. That is market profile. The very thing I just read to you that Don Jones tested 25 years ago and proved didn't work is still being taught, and they're trying to trade it. Now, what Don Jones did discover, and this is where you get to the good part and the exciting part about where we're going to go in this course. At Cisco, we felt that a database with 10 or 20 times the information in the daily summary had to be useful for market analysis. We also believed in the utility of the market profile approach. Consequently, we developed an algorithm to calculate day types. Profile theory argued for the significance of day types in predicting continuation. We felt that once we could generate day types under computer control, we could develop enough information to find statistically the conditions under which the day types could predict continuation. Our study was negative. Surprisingly, we found little or no correlation between day type and continuation. This point was the watershed in our research. It forced us to look outside market profile theory in our attempts to understand markets of longer time frame. It has long been known in futures research that markets have no day-to-day serial correlation. That is to say, even in trending markets, the probability that the next day will be either up or down is about 50-50. On a day basis, the market's normal fluctuation, the daily trading range, is much larger than any underlying trend and hence hides it. Now, this is the key sentence. Thus, it is clear that longer-term time frames are necessary to define the market's condition. You guys hear me say, we trade market condition. We are not price-based traders. We are trading market condition. You want to be a market condition trader. And the specific question about market condition, or the answer, the question and the answer is, this is an auction market. What is the condition of the auction at this point in time? What is the market's condition? You can't look on a 3-minute chart in a discrete manner and know what's going on or really have an edge in trading it. There has to be something that gives it context, and that has to be something that has validity to it. That context has to have validity. So now you have more idea about the history of market profile, and it's important. It really is important. The name of this course is the first word is foundation. It's important to understand the foundation of what you are learning and why and where it came from. And it will keep you out of the briar patch out there of all this nonsense that's going on and all this magic that is being foisted on the public because market profile is becoming more and more popular as a term. So you are going to know where this stuff came from and why and what's valid and what's not. It's really, really important. And let me say something else, and a lot of you heard me, and I'm going to show you some quotes from Stellmeyer too. Stellmeyer doesn't trade market profile. Stellmeyer hasn't traded market profile in 17 or 18 years, by the way. Now, Stellmeyer still does seminars and webinars under the market profile imprimatur, but it's sometimes I almost think that Stottlemyre wishes market profile were not around his neck, because market profile itself does not define by any stretch of the imagination what he is doing now or what he has been doing or researching for the past 17 or 18 years. And I'll just leave it at that. Now, there are a couple of terms that you may run into or you may not, but just to be thorough, early market profile was data provided by the CBOT, and it was used in conjunction with the liquidity data bank of the CBOT. And the liquidity data bank recorded trade activity and classified it based on who was doing it. And I think this is right. You had the commercials, the funds, the public, and the floor. And it was thought that, that you could read what the commercials were doing or what the funds were doing, and you could see if they were selling up here at this extreme, and you'll hear the term capping the market and things like this. Well, over time, because the trading world has blown up in terms of the number of people and institutions that trade, that all of these have sort of morphed into basically two groups of traders, the big money and us, the big money and everything else. And you'll hear me refer to the big money or not the big money. Who it is at this point in time can no longer be determined with any consistent accuracy in real time. Now, the other thing that you'll hear, and this is a legacy market profile concept, and this is tied into the idea of day type, the other time frame player. Now, when everything went through the trading floor, if you were on the floor, you could stand down there and you wanted price to stay in a range because you didn't have to pay the bid-ask spread. You could stand down there and make a market and trade the bid-ask spread and make a fortune. And that was the easy way to make a fortune. There was no reason for the pit to drive the market outside of a given range. Everybody on the floor knew it, and that was the game. Now, everybody on the floor, they would lose money when the market would begin to trade outside of a range. And the only reason that the market would trade outside of a range was if the other time frame player, in other words, somebody, a hedger would come in. General Mills would come in and buy corn or somebody like that. They would come in and take a longer-term position, and it would overwhelm the supply-demand equation in that time frame, and it would drive the market higher, would drive the market lower. Well, that's not the floor traders driving the market. There was no they didn't need that. They really didn't want it. They didn't need the risk. It was the other time frame player. So, and this was the genesis of this day type thing. It was thought that if the market traded outside of a range, outside of a certain time frame, it wasn't the floor, it was big money moving in and taking a position, etc. So that's where the term time frame player came in, and that's also a little bit about this day type stuff. Now, we may or we may not go into the day type thing later. I'm not going to do that tonight. Do you guys have any questions so far? A lot of this is background information, but I've been talking a lot and not really paying attention to the chat. Are you awake? Have I put you to sleep? I realize it's getting late. Okay, the concept quickly morphed into being promoted as something magical, and it was claimed that they could type days and predict what the market could do. It could not and it cannot do this, and a lot of this stuff is still out there and being promoted. Now, there's some other market profile fallacies and misconceptions. I'm going to put together a glossary, and I will have this glossary available for all of you in the next session. I think it's important, and I'll define some of these things more completely then than I'm going to tonight. But, this point of control thing is something I hear constantly. You hear the point of control, a virgin point of control, a naked point of control, all this stuff about point of control. Well, there's no single price. It's magical. A point of control is, to a large degree, a chronological coincidence of price activity. There's nothing magical about a point of control. We refer to a high volume node. It's an area where most of the trading occurs. There is significance to that. But the single price in that area, there's no single price that you can go back and consistently say, well, this was the longest TPO line in this, and it was, look how price did this or did that or whatever. You want to stick with the bigger picture of what the auction is doing and not try to impute magical properties to a graphing format. Day types were the early theme, very early theme of market profile, and it was an obsession of early market profile traders, and still to this day. Day types are too nebulous to be of any use, except in general terms. There's some times where a day type can be helpful in nothing else as knowing what not to do and what's likely to happen based on some basic observations and statistics, and I'll share that stuff with you. But the important thing is about the day type thing and why it's not valid is that you cannot take a market that is dynamic and is in an ongoing process of development and divide it up and slice it into neat, comfortable, chronologically divided pieces just because that's when an exchange is open or closed. We have 24-hour trading now. Even, I don't know, 10 or 12 years ago, I didn't pay that much attention to Globex in the stock index futures. Well, I do now. I don't separate it out at all. It's just one market. There's enough volume now, and the markets are so correlated now that you better be paying attention to what's happening in Globex. You have to. It's not just what happened today. It's, today is continuing right now in front of me. The S&P's up a quarter of a tick. It's up one tick. And this gets back to the context thing. It gets back to the worldview that you're going to develop over the next 7 weeks. Now, this is one of the, it's really a foundation. It's a foundational market profile principle. And it's also one of the big fallacies of market profile trading. And it's important that you understand this because we do use this concept. Part of this concept is valid, but part of this concept is not valid. And the key is, and I want to emphasize this, don't try to turn this into a rote, paint-by-the-numbers approach. You want to understand the market. All of this stuff that I'm showing you should be used to understand what the market is doing through the lens of an auction market. I'm going to get more into the specifics of an auction market next week. And then you can, those of you that may be a little bit lost right now, then you can go back and you can revisit this because they fit together. But there's the market, one of the big profile fallacies, and to this day, this thing about the P and the B, and this was actually the foundation of Stottlemeyer's early work. And he had posited a 4-step process of development. And that process of development was inefficiency to efficiency in an endless loop. And this is where Stottlemeyer's means of communicating and so much of the semantics, the nomenclature of market profile is prototypical Stottlemeyer. It's a little bit fuzzy. You're not real sure what it means. That's why I'm going to do a glossary. I'm going to do a glossary and put all this stuff together so that you know what we're talking about, but you'll also know what other people are saying, and you'll be very quickly be able to tell if they know what they're talking about. But when we're talking about inefficiency or efficiency in terms of the market and market development, inefficiency is when trade is one-sided. Today was an inefficient market. You can say that the stock market has been inefficient since December 30th. It's been straight up. It's not facilitating trade. It's a very one-sided market. The market is being overwhelmed by buyers. The buyers are in control. Efficiency is when trade is being fairly, in other words, it's fair. It's fair to both parties, quote unquote fair. And fair being the judge of both parties, where both parties are comfortable trading. It's a price that's not too high or too low to the buyer or to the seller, or vice versa. When prices are unfair, it's sort of a forced situation where the shorts, like in the stock market, the shorts are getting run over, they're capitulating, margin calls, all this type of thing. But the market will go higher until it runs out of buyers, and that's something else we'll cover at another point in time. But that's an important auction market axiom. When's the market going to stop going up? Well, when it runs out of buyers. And that's I mean, I say that flippantly, but it's important to understand that. This market is going to go up because there are buyers. There are buyers willing to buy it. Every time it goes higher, there's still some buyers. We're going to talk about the stock market at the end of this, by the way, again. Okay, the four-step process. Step one, you have a trend that stops the market. Or actually, you have a trend, then you have a stop, and then you have development around that price. And then then the process starts over. This is not properly ordered. So here's your step one. The market trends, it goes up. Then step two, the market become more two-sided. In terms of bars, it's a consolidation. The bars begin to overlap. There's chop. That's trade facilitation. That's the normal state of a market. Then step three in Stottlemeyer's initial work was the market would become mature at this point, and then you would have the first standard deviation. This was a third standard deviation. All the volume was in the third standard deviation, and you would have that volume migrate so that over time this distribution would develop such that the bulk of the trading was near the mode of this structure, the statistical mode. So that, and to this day, you hear people, well, this is a P, this hasn't been filled in, so when this breaks, it's going to be down. Well, no, that's not what happens. All we need to know, all you need to know is this. When you see this, it's opportunity. It might turn into this, and that's fine, we'll trade it, or it might not, it might go up, and that's fine, and we'll trade it too. But the migration of this structure is a big determinant well, it determines the trend of the market from our perspective, but it also determines your strategy and your trade tactics in all levels, all degrees of trading. This process occurs in all degrees of time, these three steps. You have a step one and step two, the market becomes two-sided, and the process starts over again. Sometimes it's clearer than others, but it's always there. So this is what would happen. You would have step one, step two, and then this structure would mature, and then you would have the break up or down. And basically this and this are the same thing. They're just different time frames. But you do not always have now. Like for instance, in a perfect textbook Stottlemeyer world, we would be looking for the stock market to eventually develop back down to the December low and fill in this nice Gaussian looking shape between whatever high is formed in that low, and then it would move again. And here's the B. The B is the inverse of the P. But we use this in a specific way, and we use it differently than anybody else. Most other people use it. This process is a logical dynamic of an auction market, but it's a dynamic process, it's not a mechanical one. You cannot assume that just because a market trends and then it rotates for 3 or 4 hours at the top of the range that the break is going to be down. We all know, those of us in this room that have been clients for a while, that doesn't happen. That doesn't always happen. Sometimes it breaks up again. Now, this is an example that some of you have seen before, and it's a market. This is the S&P, and here's a B, and here's a P. Now, under a perfect textbook world, we would know now that, here's your high, here's your low, and this is going to fill in a real nice, neat fashion. And all we have to do is sell here, and then buy back down here, and then buy here and sell up here, and, we just get rich the easy way. Well, the market breaks higher, and it forms another P. The market breaks higher again, forms another P. And the bottom line is, this can go on and on and on, day after day, week after week, month after month. And so you cannot rote trade the idea that just because there is a lot of volume on a stick, up or down, that it's a P or a B, and there's some magical force that's going to create the pull of that market away from the volume down towards through the stem that that it's attached to. Sometimes it does, sometimes it doesn't. But you've got to be open-minded about which way it's going to go. And, you know, the same thing for the B thing. So this is a legacy concept. It's not tradable. The three-step process, Troy will show you the three-step process all day, every day in various markets. And so will I. We talk about it. It forms a concept. You know, it forms part of the answer of the question you're always asking. What is the present market condition? If I'm looking at the S&P, and I am right now, I'm going to show you. This is a real-time example. Okay, if this is a distribution here, so this would be a step one. Now, step two would be rotation around this level, and then it would start over again. And it's not always a nice, neat, you know, coloring book diagram. Sometimes it's messy. Okay, here's a step one. And then you had this dip down here, then you came back up here, and then you had this Gaussian shape form. But it's there. So when I'm looking at a market, I'm not right now. And here's an excellent example. I sold this market today. I sold it in the room. Whoops. And why did I sell it? And I typed this into the room at the time that I did it. We had formed a balance area. And we had sold off down in here. Now, in this time frame, and I know this from experience, this is a mature structure, and it was going to break. I chose to assume, or I chose not to assume, but I chose to fade this area. So I was a seller. I sold once before it broke because my initial idea was to sell it at 99, and then when it went to 99 there was too much momentum and I ended up selling it in here, and then I got stopped out. But when I took this trade, I was trading this auction process. I wanted my idea was, okay, and I took this trade based on, you know, the reason I faded the market was because of the breadth thing and the volume thing and something else that I'm going to show you in just a minute too. I was looking for more rotation than we had seen, but I got stopped out. Now, if my risk of this trade was from about here to here, the potential for this trade was from here to here at a minimum. So this was a market condition trade, and it was based entirely on auction concepts. It was based entirely on market condition. My stop was based on market condition, and my target was based on market condition. So I was willing to risk this to potentially make this. It didn't work. I lost money. But that's the diagram of an auction market trade, and you know, using this PB concept. Now, this was a structure that was mature, ready to break out, and I faded the upper extreme of the range, got stopped out because it broke to the upside. This was the beginning of an initiative move. Okay, now this is a quote from Stottlemyre, and this was in 2005, and in a magazine interview, and he was asked the question, what would you say to traders who are using market profile as a visual display on different charting platforms and are studying your original theories? Stottlemyre, it won't be very helpful. But guys, good news, bad news. Everybody else is doing it. You know, that's neutral news to me. The good news for you is you will not be. Now, the most important thing that you can learn in the next 7 weeks is this worldview of markets that's very, very different. And some of this worldview is going to take some time to get comfortable with because it's different. It's going to be new. But the most important thing, if you can come out of this course with a thorough understanding of the worldview of auction market principles, you're on your way. And you will be on your way to understanding how markets develop. And you'll be well on your way to how you individually can develop the confidence you need that very, very, very few traders ever achieve, and that you really have to have if you're going to trade professionally. And I think pretty quickly, before 7 weeks is up, you're going to begin to understand markets and what they're doing and why on a level that most other people just aren't capable of understanding because they don't have the worldview you have. This truly is a different way of viewing the markets. And the magic and the benefit of this entire 7 weeks is this worldview. And we're going to talk about how to apply it, but you can't apply it unless you have the worldview. You have to have the basis. You have to have the foundation. This is the foundation. So this is what you're going to learn over the next 7 weeks. This is another quote from Stottlemyre, and this was back in 1996. The evolution of the fundamentals of market profile has been lost on the majority of users because most of the interest was, I would say is still, in using it to make trading decisions rather than in understanding the market. Now, 99% of the people would read Stottlemyre's work and say, well, if I'm not going to use it to make trade decisions, what good is it? Why do I want to understand the market? I just want to make money. Just show me the money. Well, you can't see the money consistently unless you understand the market, believe me. So that's what we're going to do. You're going to understand the market. Maybe some of you more or less than others, but each one of you will understand the market far better than you ever have before at the end of 7 weeks, and probably far better than the overwhelming majority of people out there that are trying to become traders. This is the Dow, and we closed, this is a monthly chart of the Dow. We closed at an all-time high today. That's quite historic. You know, we have the move off of this low has been quite a move. You know, we've had past ramps. You know, actually beginning back in 1980. I started trading right here. I've now raised my stop on my long position I took here to right here. I wish. But you can see the market is at a critical psychological inflection point. Now, the reality is that, you know, the Russell has been all-time highs for weeks. The S&P is knocking on the door. Let's see how far. It's about 3% from a closing all-time high. So I'd be a little bit surprised if we don't see that. So what do? What do we do here? You know, do you sell this market? Do you buy this market? Well, I think some of it depends on the time frame you trade. And if you are an investor, that's a question everybody has to answer. I'm not personally in anything long term with this market where it is now. I may miss, you know, the move to, I don't know, 2,000 in the S&P. I'm comfortable with that. I missed the move from here to here too, but I was comfortable with that too. So I may miss another move. But from a trader's perspective, if we're looking out 2 or 3 days, or if we're looking out 2 or 3 weeks, or we're looking out 2 or 3 hours, how do you trade this market? I mean, it's vertical, it's straight up. So let me ask the question, how do we know? What's the first signal that this market could be turning around? Is it different this time? I mean, are all of our auction market rules, do we throw that out the window? Or is this market not following these auction market concepts now? Yeah, Well, there are two great answers. When balance areas are broken to the downside, and James Barnes says a close below the low of the last day or two. Yeah, guys, it's that simple. You know, if you're an auction market trader, you have an incredible, powerful tool, which is the worldview of how this stuff works. And it hasn't changed. It's operating the same way. We're in a we're in a trend. We are in an initiative move up. You know, initiative moves happen in different markets all the time. It just happens to be the stock market now, and it happens to be in all time frames. You have long-term, intermediate term, short intermediate term, short term, and intraday, all going the same direction. Now, that's a little bit rare, okay? And that's important information. We're going to talk about that. But now, this market, the signal that this market is beginning to, something could be going on. Now, again, this is the cash to the downside. We use the exact same concepts now that we used last week, last month, last year, 3 years ago, 5 years ago, 9 years ago, 30 years ago. You see, this is an auction. These are the day auctions of the S&P. Now, when I do tonight's DBSA, the level that I'm going to point out, now it maybe I'll show you the futures in a minute, but if this market closes below today's low now, that's the earliest objective signal that suggests that there could be a potential top forming. And quite frankly, based on the other information that we know from an auction market perspective, it's very, very, very unlikely that whatever top is put in short term, whether it's here, here, or here, is the final high in this market. Let's go back and revisit that concept real quickly. This is a monthly chart. What do you notice here and here? And I can go back into other areas as well, but in the top in 1998, in the top in 2007, 1998, 2000, and this top, what do you have here that you don't have here? You know, so far you have a spike high. Now, could this market in the next day or two turn around and scream lower? Yes. But when you're looking at this perspective, and remember, this is a concept that the principles apply in all degrees of time all the time. So we're looking at a really long-term time frame here, guys. This has, multi-year, if not decade types of implications to it. So if I'm looking at this is sort of the area, if we were to take this low out here, which is now the January low is all, then, okay, then maybe this could be a top. But it's still, even if this is taken out, this is likely to be revisited. Look how long it took to form these tops. Now this is monthly, so that's probably that's of academic, I guess, interest. But let's go weekly and see what we find. Okay, let's look at the tops just since the 2009 low that formed. This was a little top. This was a top. This was a top. This was a top. This was a top. All of these have in common? Now, again, this is weekly. They all took out. Well, this is an exception, but the thing this has in common with all of these is it took out that second week's low. But most of these tops, with this one exception, and this was only a short-term top, and it bottomed right where it needed to bottom, right into this volume node. It took time to form these tops. So it's really unlikely that if we form some sort of short-term top up here, that it's the final top. Now let's go to daily. All right, now let's go back and revisit these tops. Okay, now even the top that on a weekly chart looked like there was no balance that formed, you can see this formed a really nice pristine balance area back here in 2010. And then in April, we formed this nice top. This was a bit of a funky kind of sort of top in here. This was a long-term top, but it had tops within the tops. I think this is, if I had to guess, this may be what we ultimately end up seeing, which quite frankly would be wonderful because it's a wonderful trading type of environment. Here are the tops from a year ago, and this top was revisited. So you had a balance area here, and then you had, and we'll talk about this, these concepts. Here's a balance area, here's your selling tail. You know, all of these auction artifacts, these selling tails and these balance areas, you know, they happen on, you know, we're looking intraday, especially those of us that are in the live room every day. You know, we're looking on 30-minute charts and thinking that's long term, and you know, we feel good if we let it set up on a 30-minute chart. Well, the reality is they set up on a daily chart too. The same artifacts that you see on a 5-minute chart, the same auction process that creates those artifacts is in effect in these longer term time frames. So now that brings me to where we are now, and this is a daily chart. Now, if you get on the internet, you're going to read, you know, all the predictions come out of the woodwork. I mean, you've got people now predicting that the S&P is going to double in 4 years, and you have people predicting the end of time by Friday. You know, whenever the market is trending, especially when it's at new highs or you know, important pivot lows of a yearly nature, you have both the predicting parties come out of the woodwork and start predicting either, you know, you know, we're on the cusp of an acceleration to whatever, or you know, it's the end of time, and you know, you better get short. Not sure how that's going to work out for you if it's the end of time, but that's the theory. So we can sit back, and if you forget the fact that the market has had this incredible bungee jump, and it has been incredible, let's just look at what's going on right now. And James, you know, you calmly typed in the second day back. Here's your second day back. Now that second day back would also coincide with some rotation in a high volume node in here. Now let's note that. Let's see, this is 1498. Well, let's see where 1498 is. Oh, this is daily, no wonder. All right, here it is right here. Today's low. And that would put us below this high volume node. So this is an objective, calm, deliberate analysis of where we are and what's going on, and it's tradable information. Now we're going to make it even more tradable in just a minute. So you don't have to worry about what Tom DeMark is going to say on CNBC tonight, or what Jim Cramer said, or what Ben Bernanke and Tim Geithner may not do. The auction, regardless of who the parties are or the exogenous drivers of it, is still in effect and chugging along and performing just like it did pre-2007, you know, pre-2000. I've shown, you guys have seen me show charts of the Dow back in the 30s, and you see the same stuff. So these artifacts give us a comfort level that the auction process is alive and well. Now, one of the things that I did this weekend was to take a look at the extraordinary vertical nature of the market. And what I found was, Well, that's not what I found. Let me find what I found. Here it is. I took a look at, and this is the S&P, obviously, and I'm using the S&P because if the S&P is going to make a significant move, so is the Dow, so is the Russell, and so is the NASDAQ. And I took a look at the rallies following declines of 9% or greater since March 2009 and how far they carried. And the initial rally off the low in 2009 carried, I'm having trouble reading that, 43%. And then this was just about a 9% decline. And then the next rally carried 32%. This one was 16, this one was about 32, this one was about 20, this one was about 22, this one was 16, and the rally off the December low so far is just a little bit over 12%. Now, I'm in no way, shape, or form am I suggesting that we can somehow get valuable information that we're going to trade on because you know the greatest rally off of decline was 43% and the least was 16, and this is only 12. I'm showing you this to show you the magnitude of some of these rallies. And one takeaway, one anecdotal takeaway is that, you know, we've had a lot of rallies, several rallies in this market that, well, actually all of them so far have exceeded the rally we've had off at this low, and some of them in roughly the same time frame. You have everybody going nuts right now because we're close to all-time highs. So, you know, be aware of that. Now here are the declines, and you can see this is, you know, we've really had two protracted declines. We had one in 2010, and then most of 2011 actually was a rotational market with a downside bias that tested this area in here. You can see where we spiked in here. So once again, these auction concepts work in all degrees of time all the time. If this were a profile chart, this would be a high volume node, and this would be a spike down into it, and then, you know, this was a false breakout trade. That's another auction market concept, and that's a trade setup we'll talk about. So you see these, the setups, you see the development, you see all of the things that we use to analyze and trade an auction market all degrees of time all the time. Now, one thing that I did find that I think was really enlightening. I went through, and this is called not having a life, okay? I went through and I took all of those rallies and I put them on a 120-minute chart. And then what I wanted to examine was the personality. You guys have heard me talk about the personalities of rallies before, and I've always used that when I'm talking about breadth and how, you know, breadth will develop a personality against a given trend, and it tends to stay in that personality. It tends to not exceed a certain level to the downside on retracements in an uptrend until the trend is changed. And when it does exceed it, then that's one of the signals that the auction has changed, that the supply-demand equation has shifted somehow. And another thing that I've done I went back and I looked at the retracements within these furious uptrends that we had to see if there was some sort of a pattern, and there is a pattern. Most of the time, and this is we're pushing the time here, so I'm not going to go through all of these charts, you know, each time frame. But the takeaway from this, and I'm going to bring it forward to make it relevant immediately. But each of these trends, until they ended, tended to have 2.5% retracements as a maximum, and most of them had something between 1 and 1.5% retracements from the high point to the low point of the retracement. Now, you can't trade this in a vacuum, obviously, and I don't suggest that you do that. Everything that I trade, and this has to be framed in the context of an auction market. And the other thing that I did that we're not going to have time to discuss tonight is I went back and I looked, okay, this retrace. Now, where was this retracement in terms of this auction? What was the information? Should it have stopped here? Was it logical from an auction perspective? And the answer was yes. Now, the point of this is, there's a couple points. Don't expect, you've heard Troy and I talk about this before, when you're taking counter trend trades, I'm going to short this market. I mean, I'm willing to play the short side of this market. I tried it today and got stopped out. But I'm willing to play the short side of this market. But I'm also, I have to be aware, I'm fighting the trend in every degree going right now. So if I get a short trade on and I get a retracement to the previous day's low, and that previous day's low is, you know, somewhere between 1% and 1.5% from the high, that's probably a good place to start tightening my stop or taking partial profits on the position. Now, what happens is if all of a sudden we get a 2.5 or 3% retracement, well, that's a heads up that maybe there's going to be more time spent than these sharp retracements that you see. Now, this happens to be 2010. Let me find the present, since we're in the present, right? Seems to make sense. Now, this is the S&P. Before I show this, I want to show this. I want to show the profile view. Because it's easy for me, and I think it's easy for a lot of you, that a lot of the clients that have been with us for a long time, to look at this chart and to see, quote unquote, the market profile. If you're not familiar with the profile, you're looking at this chart and you just see a chart. But there's really much more information here. And this is what it is. When I look at this bar chart, this is what I'm seeing, or it's what I'm trying to see. Okay, now, this was December 31st. And on December 31st, we had this rip-roaring trend day, that's a market profile term, to the upside. You know, the market opened near its one extreme and closed near its other extreme. That's a trend day. They're rare, relatively rare. Days like this are relatively rare. And then we began, what did we begin? Well, we began a migration of value higher. Value, simply put, and we're going to go into this in detail. I think it's next week. I think that's on the agenda next week. But for those of you that are new, the little gray areas, these are areas, this is the greatest value in this structure. This structure is an auction. So, you know, you're going to have rotation. The auction sets an extreme. All auctions have an extreme. They have an upper extreme, a lower extreme, and an area of greatest relative value. And you read the market and determine the trend of the market by the migration of that value. And until this migration is broken, the trend is up. And you can go through here and you can see how elegant, as usual, this auction process is in migrating higher in an orderly fashion. Now, if you get on the internet, you think that there's this, you know, there has not been a downtick since December 31st. The reality is, it's been a pretty orderly advance. It's been, you know, the retracements have been shallow, but we've had, you know, you've got an upper extreme, a lower extreme. You have development. The auction matures, you break out to the upside, and it starts over. So you've got this orderly procession of value higher in this market. And as Troy posted, which also would coincide with the signal James gave, the initial signal that something could be awry now is if the S&P closes below today's low. And it's for two reasons. It will be taking out the high volume node of the most recent auction, and it will be closing below the low of the previous day. Now, if this is taken out, what's the next level we're going to look at? It's going to be this one. And the guys in this that are in here that have been in this room and that trade this will tell you it's it's not magic, but it seems like magic sometimes how these markets will honor these volume nodes. Now these volume nodes, I want you to understand, I don't want you to view things like this as support or resistance. They're inflection points. Now there are certain rules, and we're going to go over this. Not rules, but guidelines. You know, the trend of this market's up, so you're more inclined to be leaning towards this acting as support than the market blowing through it, because the trend is you know, undoubtedly up. Okay, so let's go back now to the immediate trend and talk about the personality of this market since January began and since we gapped up here. Now, the other interesting thing that I find rather amusing, I always find this amusing, we have this big gap here. Now, you know, there's this magical school of thought that the gap's going to fill in. Well, it may, but it just may not be in the lifetime of your account. So the gap thing, from an auction market perspective, is what Stellmeyer referred to as minus development. It's basically, it's a one-sided market. And yeah, this gap is likely to be filled in, but it's not because of some magic or some, you know, some undeniable pull. It's just it's going to be part of the auction process. And this is unique because it truly is a gap because of the holiday. Most gaps that these guys refer to aren't gaps because they're not acknowledging what happens in Globex. All right, let's look at the retracements that have occurred since January in this market. Okay, there's 1.18%, so less than 1.2%, right at 1%. 1.02%. Now the retracements are getting shallower. Not even 1%. Less than this, not even 1%. Not 1%. Not 1%. Not 1%. So, and I spent way too many hours this weekend going through every trend similar to the one that we're in this market since March 2009. And the trend that we're in now is up there in terms of not so much distance yet, but with the lack of retracement, both in terms of depth and time. We've had very little of the balance areas that you typically get. And that's, you know, that was my, let's call it an excuse, since it turned out not to be a very good reason. That was my excuse for selling this thing today. I was thinking, well, you know, we really haven't had a 1% retracement in a long time, and we're overdue for 3 or 4 days of chop. So I'm going to be smart and sell this, and I'll buy it back down here while I got run over. Okay. But that was the rationale. So the message here is if you're selling this market, if you get a 1%, or something, and it's into an auction market level, you better take your profit. And also, if you get a 1% decline, if you want to be smart and just trade with the trend, then you're looking for 1 to 1.25% decline, and see if it coincides with, when it retraces, you know, one of these levels. Now, this will be an important level. This actually should hold. This is an attempted initiative breakout of this balance area. So this is, you know, overnight, you know, we'll see what happens, how the market develops, but this will be an important area. This is an important area. Today's lows, you know, today's lows tested this low and this low. You know, this is a buying tail. This isn't a buying tail, but the market spent very little time down here. Same effect. So hopefully I've shown you a couple of things that will be immediately useful to you in your trading. Number one, you don't have to lose sleep over when the market is going to turn. You'll get the signal and recognize it before almost anybody else. In the meantime, the trend of this market is up in all degrees of time, all the time, and the retracements are so far they're really, really shallow. So I don't see any sign of a lack of desire to buy this market. If anything, it might be increasing. So if you're shorting this market like I tried today, you're really guessing at a top like I tried today. and the smarter thing would have been to buy this thing when it was down here. Now, I keep expecting this market to become more two-sided than it has, but it may go up 4 or 5 more percent before we see a 2% retracement. So be aware of what's going on. The auction process is in effect in this market, guys, but it's also the phase of development of this market is initiative. The path of least resistance is up. And, the better part of valor is being patient and letting some of these levels come out to the downside before you get aggressive shorting. If you're going to short this market, you're doing it with small size and you're quick to take your profits. Don't try and be a hero and be the person that called the all-time top, because it's very likely this isn't it, even if we retrace back down to, the beginning of the 2013 trade. So guys, questions, comments, observations? I don't know. Matter of fact, I doubt I'll have the recording rendered in time to have it in your box tonight. But I will. It'll be there tomorrow. Please try and review this. Those of you that are, especially those of you that are doing this for the first time, try and go through this at least once before next week. And then if you have any questions about anything that we've talked about, most of the stuff this week was of a conceptual nature and background nature. We'll get more into meat of things next week. But if you have questions, let me know. Thank you, Bill. I very much appreciate all of you and your time. So, Michael, you say a year ago we had much wider daily ranges. What does the auction market methodology help us in this? I don't understand. I mean, it's Michael, if I were to show you the S&P, give me a date. Give me a contract. December of 2011 or September of 2011. September 2011. Okay? Let's look and see. Okay, here's the September 2011 contract. All right, I'm going to go back. So this started in June, right? Okay, probably started somewhere in here. Okay, now let's do this too. All right, here's the bar chart, and then we'll look at the profile chart. So this is the September contract. All right, the September contract. Let's see, September 1st. September contract probably became front month somewhere about right here. Probably right about here. Interesting. Well, this was I could look at the bar chart and tell you this was much more two-sided, but that was my point. Trends have different personalities. The personality of the trend we're in, it is what it is, and it's going to stay what it is, and knowing what it is gives you valuable information. It will be quite, these trends that establish themselves in these rallies, that they develop a personality and they stay very consistent. Now, all right, now this is that September contract. So we migrate higher. And then you did get, I mean, you did have some rotation in here. We have not seen this at all in this rally. Now, what is this? This entire thing is an auction. So you've got to take all of this. This is all one auction. Sort of a funky auction, but an auction nevertheless. And then on the 27th, you began migrating higher. Here's your migration of value higher. And it did become rather, the trend rather pronounced off of this volume node. And this is that September contract. Okay, and here you had some rotation. You know, you had another balance area that formed. And then the market traded higher in here. And then look, you know, here was your initial signal. Something was awry. You had this big move in Globex that took out the previous day's volume node, and look where it stopped. It stopped right in the high volume node from this structure. And then the next day traded into this overnight conviction, and you started down. So, you know, Michael, that's one of the cool things about this. You use the same concepts regardless of the range, and that speaks to the robustness of this. Regardless of the volatility and regardless of the range, the auction is in effect. You know, one of the seminars that I've given, one of the courses has this example of VIX in 2008 when the average true range was something like, I don't know, 60 handles. You know, the VIX was just, you know, I don't know, it was astronomical. It was an all-time high. And then I showed an example of the VIX and a profile from 2007 when the VIX was like, you know, 9. And if you looked at those two, they both looked exactly like this structure right here. So the auction is dynamic. It's in effect. You have unfair highs, you have unfair lows, you have a range of relative fair value regardless of the volatility or the lack of volatility. That's what makes this tradable regardless of what's going on. You just have to be willing to accept what's going on and not say, wow, you know, sure isn't much range here, I can't trade this. Well, just trade what's there. And if what's there is not going to change, if you can't trade it, then don't try, because it's not going to be something that it's not until it changes. Robert, I'll talk to you about that tomorrow, okay? I think Ninja has profile charts, yeah. You can get profile charts a number of different places. I'll call me and we'll talk about it. Guys, Michael, that was a good question. You know, basically, the auction is there, regardless of the volatility of the range. Thank you, Kim. So guys, anything else? Robert, this is the tip of the iceberg, buddy. Sean, I've always been skeptical of paper trading. Do you think there's an inherent difference between virtual money and real money? Yes, there is a real difference. Most definitely. But you're smart. And I used to not believe in paper trading, but I do. I do now. I really do. I've seen too many people. It's just, you're going to, people that begin to trade with real money always lose their money. Always. Paper trading gives you the best chance of not losing your initial trading capital and of actually becoming profitable out of the box. It gives you the best chance out there. Now, it's not the same for a lot of reasons, but it will at least get you in the practice of identifying and executing trades in areas, which is what you need to be focusing on anyway. You need to be focusing on not so much how much can I make paper trading, but am I consistent in my process of my entries and my exits? Am I Am I identifying good trade location? And if you do that paper trading, then there's no reason you can't do it with real money. But it's not a game to see how much money you can make paper trading and then see if that translates into the same amount of money real trading. Robert, did you see John Ocknick? He posted a profile chart plugin. Here, you see it? Thanks, John. So guys, anything else? Okay, let's go get some sleep. Come in and make some money tomorrow morning, maybe. At least on paper, right? All right, good night, guys. Thanks.